that the economy before COVID, which was running at a fully employed level, was running $1 trillion deficit. You're not supposed to have $1 trillion deficit when you have a fully employed economy. So, we then got COVID, and now we're spending into oblivion. We have a very difficult situation out there, because I think in the near term, it's hard to fight the market. You have extraordinarily stimulative fiscal and monetary policies, all of which I think is pulling demand forward. But somewhere along the way, we're going to have to pay for the party when the party is over. We talk about the poor performance of the economy. I'm not an economist, but let me just share with you numbers that strike me as interesting. If you talk to most economists, they would say trend real growth in the economy is probably around 2%. Trend real growth is derived by looking at the productivity growth of the economy, which is about 1.5%, and labor force growth, which is about 0.5%. So trend real growth in the economy is 2%. If you talk to most economists today, they have real growth fourth quarter this year versus fourth quarter last year of 6%. So we're growing at 3 times trend, yet the Fed feels necessary to keep interest rates at 0. Okay, and what the Fed is doing is they're pushing everybody out in the risk curve. The person previously who was very risk averse and bought T-bills concluded, I can't survive on 0, so I'm going to take duration risk and I'm going to buy T-bonds. The T-bond buyer says, well, 1% doesn't work for me. I'm going to buy industrial bonds. The industrial buying person concludes, I can't get by on 2 or 3%, so I'm going to buy high yield. The high yield buyer says, I can't get by on 4 or 5%, so I'm going to buy structured credit. The structured, which is more opaque. The structured credit person says, well, given how hot the market is, I'm going to put 25% of my credit fund in equities, and the equity guy is now moving into Bitcoin. So everybody's moving out in the risk curve, and they're being forced in that direction by very stimulative fiscal monetary policies. And somewhere along the way, we're going to have to pay this price. I have this dual outlook. I think the near-term outlook is probably okay. Long-term, I think that we are borrowed from the future. And whenever you bought into the market when it was selling at the present multiple of, say, 22 times or higher, you've never really made any serious money 1 year, 3 year, 5 years out. I think that's what we're looking at. I think we are borrowed from the future. And we should understand, as much as I voted for Biden, I voted for my values, not my pocketbook. He's talking about higher corporate tax rates, higher individual tax rate, higher capital gains tax rates. We have more progressives in the government, more protectionism. They're attacking these high-tech companies that are probably the main source of growth in the economy and have done a fabulous job in dealing with the virus. I mean, it's a less pro-business, less friendly business environment at the same time where the Fed and the Congress is just pouring more fuel on the fire. So it's a very interesting thing. Many times in your program, I quote the great John Templeton, who's observed bull markets are born in pessimism, grow in skepticism, mature in optimism, and die in euphoria. There's a meaningful chunk of the market today that's in euphoria. You see 50% price move. You see a SPAC a minute coming. That's stuff that's ringing the bell. Okay. On the other hand, I find a lot of things that are attractive. So I'm finding things to do, investments to be made, but I'm very skeptical about the longer-term outlook.
Shepard Smith here. Thanks for watching CNBC on YouTube.